Hey YouTube, this is Zach with Achilles Financial, and today I wanted to address the capital gains tax news that came out today, which says that President Biden is reportedly proposing to raise taxes on the long-term capital gains for individuals earning $1 million or more to 39.6%. This would be tied to the existing 3.8% investment surtax on higher income investors, and that tax could rise all the way up to 30 or 43.4%, and that is not counting state taxes. So the first thing that we want to talk about today is what are capital gains tax and how does this affect you? Most of the people who watch this channel, I imagine, do not earn a seven-figure income in a single calendar year, myself included. For that reason, we still want to know what is the impact of this tax on us. So what is capital gains tax? So capital gains is essentially the taxes associated with selling stocks, bonds, jewelry, coin collections, and real estate. I would say 90% of individuals are really only ever going to see this on the stocks and bonds side, as well as potentially on the real estate side of the house, although most of us will not have to pay capital gains tax on real estate unless you own more than just a primary residence. So why is this important and how does this affect the market? Well, currently, and I will showcase this over here, and I pulled this chart directly from Investopedia, and I will make sure to link their article on capital gains tax in the description down below. But this is what the current tax rates are for long-term capital gains. I want to highlight long-term is greater than 12 months. The reason that all of this is super impactful is because anytime you are selling any of this under 12 months of holding, then you are going to pay your realized income or short-term capital gains tax. Realized income is generally your current income bracket. Again, most of what you see here on the screen, the real incentive here is for the average investor, you're going to fall into either the first or the second category. So the advantage here is going to be that for the most part, if you are holding a stock for at least 12 months, so if you bought Tesla last year in March, then you sold it today, it would be considered long-term capital gains. If you are single or married, which again, most of us are going to fall in one of those two categories, then you have the capability to really massage some of those different investments and see how you are going to be utilizing those inputs or those different factors there. So the key thing to highlight here is most of us are not going to have to pay any taxes on our investments between the 0% to 15% category, which is all the way up to $441,000. That is not an insubstantial amount of money. That is a lot of money. The reason that this is so important is because the difference between if I were to go out and earn $400,000, your realized income or your effective tax rate would be closer to 32%, which is more than double that 15% that you see right here. So it's important to note that because this is already showcasing a huge increase from what people are currently capable or able to do. What I did want to highlight is how there could be a difference between those and what that may look like. So under the current approach, if you had a capital gains income of $10 million, long-term capital gains, the reason I want to highlight this is because that long-term capital gains is important because it encourages investment into United States or really just US stock market based companies. It encourages investment into real estate here in the United States. I think that capital gains incentives are incredibly important because it encourages stability. Now, what we're looking at here though is that if you earned $10 million today, under the current tax bracket and the approach that you have right here for all capital gains, you can see my math in here, screen cap it if you want to see that, but it aligns with the chart you have on the right hand side. Essentially, the effective tax rate is going to be close to that $2 million mark. So that's what we see here. So we've got close to $2 million. That leaves a net income of $8 million. Now, on the proposed, utilizing all of the same math that you can see right here, you still have a total tax of more than double what we saw under the current proposal. And I am by no means a tax professional. This is just my opinion and what I'm reading here. Just got to throw that disclaimer out there. But you're left with $2.1 million less than you would today under the current administration, or rather under the current tax proposal. So why is this important? Why does this have an impact? And why do we want to be watching this? This is going to cause a lot of instability and volatility in the market. At the end of the day, that's really not going to affect a lot of people, except for the 40% of Americans that do own stocks, especially those of us who have it in retirement accounts or who actively trade them. It's very important to note that this is going to have a large impact on those portfolios, because why would I hold stocks for a long period of time, greater than 12 months, if I'm going to be taxed the same way as if I would buy and sell them? Essentially, it's going to be right at a 2% difference. So if my stock goes up 10% today, I am currently, if I have a $10 million investment, it goes up 10%, I now have the capability to have $1 million. Why would I not sell that and go ahead and collect that $1 million if I already know I'm going to have to pay $400,000 on that today? That is a huge incentive of the long-term capital gains tax, is to encourage and to apply this type of long-term hold approach to both real estate as well as stock holding. So we're already going to see a lot of volatility. The idea behind this is that these taxes are going to be utilized to fund the infrastructure program as well as this American Family Act. So let's go take a look at what this is really targeting. So I hope that this comes through appropriately on YouTube, but what you see here is the percentage of the share of the total net worth of the top 1% of Americans in the United States and the bottom 50% and the share of the total net worth. You can see here that currently we are actually split between 31.4% of the total net worth is held by the 1% in the United States, while the bottom 50% only holds 2% of the total net worth. Now, what we're seeking to do here, or really what the bill, the American Jobs Plan, is looking to do, is they're looking to take from the haves and give to the have-nots. That's what we're seeing happen in the act here, is take away from those who are earning more than $1 million a share. Now, what I think is actually going to happen is this is going to just destroy the middle class at this point in time. This is a economic opinion, and what we're going to see here is most of the net worth that is held by the 1% are not necessarily your high income earners, although they do earn very high incomes. But oftentimes you see it is largely held by other assets such as real estate, such as other asset classes such as stocks. Because the top 1% does hold that, though, they aren't going to go out and actively have to sell this to maintain that lifestyle. Rather, what you don't see here on this chart is the 51 to 99 percentiles that is going to be holding the other 70% or 65% of the wealth here. And a lot of that upper middle class is going to see the impact of this law a lot more than either of these two categories right here. That, combined with the increase to the corporate tax rates, which, if you recall, the mega caps don't really pay corporate taxes, but you know who does, is small businesses, you're going to see them get double whammied here. So what we're really going to see is the people with money are going to be able to stay around. They're going to be able to buy up those businesses. They're going to be able to buy up that land, causing this gap to diverge. But also you're going to see that top 1% is going to continue to perform at a very high level, whereas the middle class is going to get pushed down. That's just an economics approach, and that is my interpretation of what I anticipate this law going to do, or what will happen. At this point in time, it is proposed, and we should see more coming next week. So when that comes next week, I anticipate that it will have continued volatility in the market, and this is what we're going to be watching. So if you like this type of content, please leave a like and subscribe. I do plan on continuing to cover this, and let's continue to watch how this affects the overall broader stock market. So thanks for watching. I'll talk to you later.